this presentation, we're looking at portfolio management. This is for our final project for 452. We're looking at student managed fund portfolio, a South Asian student, fund managed by South Asian student. In the portfolio, we have 21 different companies. In this project, what we basically did was we evaluated the overall performance of the portfolio. We looked at average returns on each company of the portfolio, and then we calculated the average return and risk of the whole portfolio as a whole, and then compared it to the risk and return of S&P 500 index. We used FTS software to derive the efficient frontier, and we based our weights for each company based on the efficient frontier model. And we also determined our top and bottom companies based on historical data and trends, and we decided which companies we think we need to sell, and we also decided on some companies to buy based on the risk and return analysis. These are all the companies in the portfolio that are in the portfolio. So for our top and bottom companies, what we basically did was we looked at the different ratios of the companies in the portfolio in the last 5 years. We looked at their trends over the 5 years on these ratios. We looked at each company's asset management and short-term solvency ratios. We looked at companies' return on asset and return on equity ratios and compared them to one another. We also looked at each company's growth potential based on their price earnings and PE ratios. We looked at financial leverage ratios and profit margin. And we looked at the company trend as a whole and based our top and bottom companies. So based on our analysis, our bottom 5 companies that we found out was Bristol Myers, Exxon, Beatrice, IBM, and SAP. And then we decided to buy 4 companies, DraftKings, Disney, PayPal, and Taiwan Semiconductor.
Thank you, Sabina. Thank you for your introduction. I'm going to take over from here. Thank you so much. So as you can see on this slide, I have a table here. I have a return, risk, and I have 2 portfolios and 1 S&P 500 index. So what I have found here is my return goes up as I go from S&P 500 to student management portfolio to the new portfolio that you made by adding 5 new companies and removing some companies. And as our return has increased, so does our risk has increased as well. And after that, what I try to do is I try to figure out what is our return per unit of risk, so we can compare whether our return has increased significantly than the return or our risk has increased less than our return. So when I do the return per unit of risk, in this one, the per unit of risk is 100%. I found out that S&P 500 per unit of risk has 12.23% return, and student management portfolio has the lowest return actually, and the newly managed portfolio has actually a high return than the student managed portfolio. So in this sense that we can tell that we have increased our return by decreasing risk, in this case for new managed portfolio than the student managed portfolio. In the next slide, what I have done is I have used the historical data return, the weekly return data, and use those data for student managed portfolio to plot efficient frontiers on our FTS system. And there are some constraints that I have used. I have used my weekly return to be 0.54%. My volatility is found to be 2.53% in that case. We do not allow any risk-free rate. We do not allow any short sales. And what you found with that is we find out the weight of the companies that we should have in our student managed portfolio. Top 5 companies according to weight are Microsoft, Amazon, Texas Instruments, Qualcomm, and Johnson & Johnson. And these top five companies, according to the FTS in our student managed portfolio, says they should occupy about 75% or about 76% in total, which is a lot in just to invest in just five companies, especially when they talk about diversifying our risk. So what I did is I plotted the companies of our new portfolio that you made by eliminating some and adding four new companies. And for our standard comparison, what I did is I put our risk weekly return to be same as 0.54% is, and I try to figure out what is the volatility in this case. And as we see, the volatility in this case is 2.44, which is lower actually than the volatility we found out on our student managed portfolio. So we can say here that we have, for the same return, we have decreased our risk actually, uh, uh, and I think and this is what our goal has to be. Either we have to increase our return for the same risk, or we have to decrease our risk for the same return. In this case, we have been able to successfully decrease our risk for the same return by changing some of these companies in our portfolio. And according to the FTS, the top five companies in our new portfolio is Microsoft, Amazon, DraftKings, Taiwan Semiconductor, and PayPal. And if you look at it, none of these companies are weighted very heavily. And the total weight of these five companies is around 51% or 52% in actual. All these companies are nicely distributed. The weight of all these companies is nicely distributed. And this is the efficient frontier of all these companies that you have in our portfolio. Actually, uh, I draw the efficient frontier line by eliminating the risk by looking at this risk return. And the companies that you have in our portfolio is Johnson & Johnson, Triple Q, Microsoft, Amazon, Taiwan Semiconductor, PayPal, and DraftKings. Our most riskiest company here is DraftKings, but it has actually the very high return as well. And thank you so much for your attention. And now my good friends are going to talk more about the selling strategies, as well as why did we include our new companies in our portfolio and backtesting and stuff. Thank you for your attention.
Hey guys, my name is Corey Laddin. How are y'all today? And for this presentation, I'm presenting the trading strategy along with a few reasons why we like the stock. So for our trading strategy, we're using a simple moving average crossover strategy. The strategy is set up in two basic ways, a small moving average and a long moving average. For the sake of this strategy, we use 5 days and 25 days. So we're looking for two indicators here, a golden cross and a death cross. When a golden cross happens, it means the stock is a buy. When a death cross happens, it means the stock is a sell. But when a death cross happens, it's not a clear indicator at all times that it's an instant sell. If we look at the yellow line right here or the yellow arrow, it's a choppy condition or a choppy trading condition, which can give your trading signals a few different indicators. Now, if you look at the red arrow right here, this is what is known as the death cross. The small moving average is moving below the long. And then we have the green arrow where the small moving average is moving above the long. So for the next few slides, I have performance metric and an equity curve. My performance metric really just measures how my stop losses have done throughout the trading strategy. So if we look, our positive returns are pretty well, and we have some negative returns of almost 90% or a little bit above 94. But according to our equity curve, we actually performed really well. The strategy won over, well, maximized about 400% versus if you look at the trading for the stock individually. Now, if we look at Disney, it's basically the same way, but the strategy really wasn't that great of a strategy because For the majority of the time that I backtest this strategy, Disney was a dividend paying stock. So my preference is not to use this type of strategy for a dividend paying stock because it's not profitable. But around right here, according where it starts to gradually increase, Disney cut their dividend payout and this stock started really trading a little more volatile. And if we look at our stop losses right here, it was a profitable investment, but we did face a lot of loss, a lot of negative return. PayPal, PayPal did pretty well, and you can see that we struggled right here on the strategy, but we started to really move up toward the end as our stop losses became tighter and better. And then we have DraftKings, another performance metric positive ratio where we did really bad. This strategy really didn't work well, or our stop losses didn't really cover what we should have. So really the way to adjust it is to create a tighter spread, tighter stop loss. But I should indicate that this is a closed and open strategy. When you're using a strategy like this, high frequency traders really use 1 second or 1 minute measurement to get the stop loss that they want and maximize their gain. But our equity curve did pretty well. We were a little choppy, but we still outperformed the stock. So it was a profitable trade or a profitable strategy. Next, for Taiwan Semiconductor, we also had a really good strategy here that worked out pretty well, maximizing almost 200% gain and a little under 100% losses. But once again, this is a dividend paying stock. So once it started trading right here, it was a little shaky, but once we created a tighter spread, we started to maximize our gains and got up to 350%, which is a nice return. So why do we like these companies? Well, we like ChargePoint because it's an American electrical charging company. If you own a Tesla, it's likely that you're using the company to charge your Tesla. But there's an expected ban, especially in California in 2035, where the stock or where gas vehicles are not going to be allowed anymore. But you have Joe Biden's infrastructure bill, which is indicated to be $2 trillion worth. The bill for electric is going to be around 300 to 700 billion, which is going to help this company particularly because government vehicles are expected to transform to all electric. Now, what makes the company even more special is that the level two charging market share that they have. They have 72% in the United States versus Tesla and Blink. I believe Tesla has about 19% of the shares and Blink has 9%. So they dominate the market share. And it's and if this bill does pass, it is expected to do really well. Now we have Disney. Disney, well, who doesn't like Disney? But right now we're thinking this is going to be a recovery play, which will definitely help out. The company recently just invested 4 billion into their parks last year and added the streaming service of Disney Plus, Hulu, ESPN Plus. Combined, they have about 100 million subscribers, and right now, according to Disney 10K, they're not profitable. They will be in 2023. All three of them will actually be profitable. So, but really, we're speculating that with the parks reopening and coronavirus fading out, that more people are going to flock to the park, more people are going to want to go to their resort, take their cruise, whatever it may be. And we think that Disney is going to do really well and definitely profit from that. PayPal, I'm pretty sure a majority of the people in this class definitely use PayPal, which is obviously a large online payment and transfer payment system. You could either buy with it or you can transfer money between it. But they also own Venmo, which Venmo has about 250 million subscribers, and PayPal has about 360 million subscribers. So combined, at about 500, over 500 million subscribers. They're doing really well. Venmo alone um, brings in a revenue for PayPal of about $1 billion. So that's really nice. Plus, PayPal makes their money on transaction fees, credit card, which interest, and they have that fee. Plus, really, cryptocurrency is what's going to help this company, according to the CEO. He called it a growth engine. So if you invest in cryptocurrency, you should know that there is a transaction fee or whatever it may be, Bitcoin, Ethereum, Lithium, they all have their own type of fee, own whatever. So this will help the company. DraftKings is the online betting and fantasy sports app. I'm pretty sure a lot of people are familiar with this. Really, the one thing that's keeping this stock down is that 14 out of 50 states have legalized sports betting. What we're really looking for and counting on this stock doing is adding New York, Texas, and California. In my opinion, New York and Texas will probably be more likely than California. California is owned by Indian, and their casinos are pretty much owned by all the Indian as well, which is going to make this state a lot harder to break into. But we're betting on the population to increase this sport to become a little more legalized across or within the next year or two, which will allow more gambling to come through. So DraftKings had a deal with UFC, some NFL teams. They're exclusive within the MLB. They have some deals with NBA teams, some deals with NHL teams, and they are just merged with a partnership with this network, which would allow you to bet and watch games straight from your TV. Now we have Taiwan Semiconductor, which produces 5 nanometer and 7 nanometer chip that power most of the electronics that you likely use, specifically Apple. Apple uses pretty a lot, or 50% of their product contain their chip. And this company has over 500 different customers that include Texas Instrument, Broadcom, Intel, which Intel make their own chip, but this company actually supplied more for them, and they're actually further advanced. What makes this company a little bit more special is they're actually trying to create the 3 nanometer and the 2 nanometer chip, which if it does come out, which is going to definitely soar the stock price for this company. So this is a little bit of why we like these companies, a little bit of our trading metric. I'll present the Excel file that we created. So you can see that I have trade signal, transaction price, return, daily log return, current position. And I really think with most, oh, well, right here, I use Bollinger Band to see the resistance level and the support line to see where the stocks are trading. And most of these stocks right now are trading in the long term, I mean, the short term downtrend, which there is no entry point right now. Or if there is an entry point, they're not profitable investment on a trading scale. But for our portfolio stake, assuming that we hold these stocks for a year, now will be the time to buy them. So this concludes our presentation. I will briefly show you the rest of the file that I've created. You have the resistance line, I have the support line right here. This stock looks like it's trading downward too, but we have to note that over this past week, the stock market had taken a step back. Bond yield, people are inflation. If you're following the market, you know that right now it's probably not a great idea to be in the market, but long term, it can definitely be a profitable investment. So this concludes my presentation, and thank you for watching. I hope you learned something.
All right, this is a presentation regarding the securities removed from the portfolio. To start off with, we have Viatris, who was noted with a negative mean return and a very high level of risk. So as you can see right here, they had that negative return of 0.275 with the level of risk 5.3%, which is one of the highest in the portfolio. Looking at ratio analysis, we could see that they had a volatile profit margin, which is an indicator of instability in their revenues. Next, we noticed decreasing return on assets, which is an indicator of deteriorating performance. Next, they had volatile earnings per share, which were frequently negative over the observation period. Next, we saw that they had declining return on invested capital, which shows that the company is not using its capital efficiently. Now, the next stock is going to be ExxonMobil, who also had a negative mean return, which you can see over here at negative 0.088% with a risk of 3.918%. Now, over to the ratio analysis, they had a decreasing current ratio, which is an indicator of a reduced ability to generate cash, which is quite concerning. They also had volatile earnings per share, which were negative for the last few periods during the observation period. And they also had poor recent performance in the profit margin, which is just another indicator of continuous decline for the future. Next, we have Verizon Communications. Now, Verizon did have a very low mean return, but they also had a low level of risk compared to the rest of the portfolio. However, the return was still incredibly low, so we did decide to drop it. Now, looking at ratio analysis, they had decreasing asset turnover. Now, this was also accompanied with a decreasing return on assets, and this just shows performance concerns. Next, we looked at their short-term ratios, which were all very low. Now, their current ratio varied, but it maintained a value below 1. Next, we looked at the cash ratio, which was less than 0.2 for most of the time period. Finally, we have International Business Machines, who had a low mean return for the level of risk. And as you can see, it was 0.046% just for 3.47% on the risk, which is again comparable to a few other stocks in the portfolio, but still the level of risk is too low. Looking at the ratio analysis, we saw decreasing current ratio in quick ratio, which just shows that IBM is unable to generate cash and they're unable to meet those short-term liabilities. Next, we saw a decline in the asset turnover and the return on assets, which is an indicator of poor performance, as well as a decrease in the return on invested capital. Moving on, we have Bristol Myers Squibb, who experienced a low mean return for the level of risk. Looking at the ratio analysis, we saw poor recent performance from 2019 on. They also had decreasing asset turnover with profit margin also decreasing, as well as the return on assets. Their earnings per share was negative multiple times during the observation period, which was just another indicator of poor performance. Moving on to the additions to the portfolio, we first have Disney. Now, Disney had comparable return and risk to the rest of the portfolio. However, they had other reasons as to why we chose to add them in. Looking at ratio analysis, we saw an increasing debt to equity ratio, a large increase in profit to earnings ratio, and short-term ratios remained constant, which just indicated stability. Next, we have PayPal, who had very high returns with a moderately high risk. As you can see, their return of 0.828 was the second highest in the portfolio with a risk of just 4.4%. Or I'm sorry, their risk was 4.4%. Oh, these are switched, I'm sorry. Looking at ratio analysis, we saw short-term ratios remained constant, indicating stability. Profit to earnings ratios experienced excellent growth, and there was a strong increase in the earnings per share. And finally, we have Taiwan Semiconductor, who had very high returns with moderate risk. Ratio analysis, their price to earnings ratio doubled over the observation period. They had an increase in the return on invested capital, and they had growth in earnings per share. And that will conclude this presentation on the changes to our portfolio.